This is kind of my generic slide of really, what's going to drive profitability here in 2014. And, while this is generic, I think it's important to note that a lot of things have really changed. If I would be giving this presentation last year this time, we would have been talking input prices, input costs, really managing those margins as far as production costs, and really, protecting it as much as we can. With this, record production for crops, we've really seen moderation in those production costs. And now we've really seen, kind of what's been introduced into the market, the supply factor as far as PED, and kind of the uncertainty that that's causing in the market. The last hog and pigs report did show, an impact from PED, something we hadn't seen in the previous report. Was a little bit surprised to us. We are seeing impact on hog supplies, pipeline supplies, as well as some of our productivity that we've been seeing record levels at in hogs saved per litter. So really the question is, and I think the market's really debating this, given what our numbers are, given what we're really projecting, what will hog slaughter actually be? What will hog weights actually be? And will hog demand hold up? What the market's doing now is really just introducing a risk premium in there, offering rather strong prices as we move out into 2014, and just really hedging their bets on what those hog supplies are going to be. So just quickly, first to review, some of the input prices and production costs. As far as, this is our baseball card for corn, you could call it. This is from the WASDE report released January 10th. And kind of the final numbers on the 2013-2014 marketing year as far as production. They made a slight revision in the yield estimates, which brought down our production slightly, but still record production as far as corn. I think the real key factors are what these corn demand are going to be, so the gray highlighted there. And the one that's really got me scratching my head and questioning is the feed and residual number. If you compare that feed and residual to what we see in the previous year, 2012-13, 4.3 billion. They're ratcheting that up to about 5.3. Think about the number of cattle we have. We're in one of the deepest troughs we've seen in the cattle cycle. We know how long it takes to build the cattle herd. Pretty optimistic on that feed demand. It also is residual, so it is kind of the balance sheet approach of everything else. But still, even taking into consideration residual, seems pretty optimistic on that feed demand. Ethanol demand, that given what the RFS is, I think that's pretty consistent with expectations given corn prices. Exports also the big wild card. We're becoming increasingly competitive on the world market for corn. How robust could that demand be for exports, and could that strengthen some of the prices for corn? USDA projected the season average price between $4 and $4.80 for a midpoint of $4.40. Right where the futures market is suggesting for 2014 prices. If we look at yield, I think it's tremendous how much we've seen response in yield from our 2012 crop year up to above trend line if you look from 1975, and just below trend line if you kind of drop out 2012 year as kind of just outlier in the data. Tremendous response from coming off a drought year. Typically in a drought year, it couldn't take 1 to 2 years, but we've jumped right back up to trend line yield. As far as world corn production, we look at Brazil. Their first corn crop was a lot better than their second corn crop. Also, if we look at their acres, were down about 7%, as well as their yield. So coming in quite a bit softer on total corn production in Brazil. Argentina's dealing with some heat stress and decreasing their production this year. So this just sums up those demands for the WASDE, and really just here to highlight, how much strength we would need in that feed and residual demand to ramp back up to levels seen, previous years with a lot more cattle on the ground, and a lot more demand needed for that corn. If you look at ending stocks to use, and we look at that big jump we've seen here in the 2013-2014 marketing year, there's no surprise that we've seen the softening in the prices that we did see and expected to see throughout this next year. And really, it's been a story of story of two tales, moving from old crop production to new crop production. Tremendous decrease in corn prices, and really those prices have continued to soften with only some slight moderation lately. We've seen ethanol production ramp back up. I'll show the corn grind for ethanol on my next slide, but operating margins for ethanol have increased. That red line there is the operating margin, essentially profitability, over the black line of capital cost for ethanol margins. Corn grind for ethanol has really kind of mimicked the flip side of those corn prices as we've seen the corn grind go continuously up. I think the kind of moderation level for corn grind for ethanol is between that 92 to 94 million bushels, something we've hit, and now I think we'll start to see some kind of balancing around that point. Interestingly, if we look at specifically hog diets here and how distillers' grains are priced into those hog diets, the red line represents when they're most competitive with corn, dry distillers' grains in hog diets. And it's been some time since we've really seen that. If we look over the last year, as we've seen corn prices starting to soften now, but distillers' grain have really remained relatively high to corn, and only recently, I think I'd note here, the last 2 weeks have softened off levels, above 200, 220 that we've seen previous. Here's some forecasts for corn. Quite a bit of carry right now in the market. As we're seeing, that's really kind of a switch from last year where we've seen prices soften as we got a better realization through the summer, how large harvest was going to be. Here, quite a bit of carry back more into a traditional marketing sense, and that kind of pattern and carry expected into next year's corn prices. I always like to look at the volatility in the markets because, we can look at futures prices. Everyone can make a forecast, but also look at, what is the probability of some of those corn prices out there. And when I started doing this was when everyone started asking me, well, what's the chance we're going to see $10 corn? This was last year. And really, I could never have, a good scientific answer. It was just always my best guess. So I went and looked at the futures market, options market, and backed out the volatility of those corn prices. And we were looking, last year when I was getting those questions about $10 corn, tremendous tails, upward tails on those corn prices because, there's quite a bit of probability if we continue to see demand pretty strong, not as much rationing, potential for higher and higher prices. Right now, we look at pretty evenly distributed probability around those prices, and not too much tail one way or another. I think the market right now has, the demand situation as far as exports, as far as feed demand, pretty relatively priced into it. If we look at beans, not many changes to the last WASDE report. As far as, demand, I think will continue to remain strong, and that's why I think we're seeing soybean prices being sticky the way they are. Soybean meal prices, at least here in the near term, are pretty sticky at where they're at. Pretty wide range USDA is projecting on their prices of $11.75 to $13.25 for soybeans. Trend, below trend line yield from soybeans, but fairly close to those levels. Did make a considerable bounce back from what we've seen here in 2012, 2013 marketing year. Brazil here, we're seeing, record production in Brazil. They're getting it mostly at par yield, but record acres planted for soybeans. Seeing that real big bump mostly attributed to Brazil there on the world market. Pretty consistent levels here. I think the big wild card and how much softening or strength in the prices we could see for soybeans is that export market. Right now, USDA has considerable increase from what we've seen last year. Not unexpected, but that could be pushed even more as we're seeing ramp up world to market for soybeans. Pretty leveling of stocks to use ratio and some softening of prices. Soybean futures really kind of follow that similar pattern to corn, but really when we look at the soybean futures, it's only those really deferred contracts, September, November of 2014, that have really started to soften. Keeping in mind, next year's crop production, new crop soybeans, and pretty stiff relative to, current crop prices, current soybeans. Soybean futures, that a lot of that softening has to do with world production coming online and expectations that we'll see softening in prices in soybeans, as well as potentially some of those acres that we've seen in corn. We've seen those record acres in corn, some of those going into soybeans, and very much softening a lot of those prices, especially for the 14-15 marketing year. Soybean volatilities, definitely a shift as we move out through, the marketing year here for soybeans till we get back to softening of prices of, midpoints of that $11 range on the further deferred contracts. Soybean meal. This one very much has lagged, soybean prices, any softening we've seen in there. But, I think similar to the soybean case, we'll see some softening in those prices as we move out, especially here, kind of lot narrower tails as we move out into these more deferred contracts. A lot more of that probability is weighted back towards, current futures price levels. So, how many corn and beans are we going to see the next few years? What crop prices are going to be? These are estimates from Iowa State University that show corn prices in the blue there and corn costs in red. And here's to try to make my point. I think we're going to start seeing some shift in acreage, back to livestock production, back to some other alternative crops, because we've seen a big spike the last several years of prices over costs. But what happened last year? As far as our estimates show, costs are above prices, and that could continue given the record acres that we've seen planted. How much production has really come online, especially considering the demand. We can only ramp up demand so fast, so far. When we're talking about corn-based ethanol, there's a projected level on that. We're talking about feed demand, there's a projected level on that. And so, we could see quite a bit of moderation in prices here as we continue to see, if we can continue to see the number of acres or anywhere close to the number of acres we've seen. Soybeans, I don't think we're there yet. We're seeing, costs below prices. We've seen that last year. Projected next year is close to, break-even levels, as we've kind of seen those soybean prices a bit stickier. But if we do see some transition of acres into soybean production, that could begin to soften some of those prices. So what does all that input cost of production mean for hog profits here in 2014 and looking back also what we've seen in 2012 and 2013? This is our cash model basis. It's been projected at Iowa State University since, I think, the early 80s or late 70s. And what this model is just placing, or it's farrow to finish production, determine a cash market model, no risk protection. Really what we're projecting there is $20 profits as we look out into 2014, as we've seen very strong seasonal prices in the summer months, moderation of those production costs. This is coming off of estimated profits in 2013 of around between $8 and $9 on average, negative $12 on average for 2012. If we look at farm level cash receipts and maybe start to talk about, all of agriculture very cyclical when it comes to returns, when it comes to production. I mean, it's the reason we have the cattle cycle and the hog cycle and all of those. But when we're seeing, the last 5 years or so, the farm level cash receipts, so that's just, the revenue stream of things, has really favored corn and bean production. We've seen, it go above its levels between 5 and 10% corn and bean as a percentage of farm level cash receipts, upwards of 15% for corn, 10% for beans. And we've seen really that percentage for cattle and hogs, come down from its historic high levels. But I think we're really kind of in the midst of, some of those cyclical patterns in crop and livestock production as we kind of cycle back to, potentially building the cattle herd, continuing to build hog supplies. We could see kind of that switch from, higher revenues, more optimism, chasing more animals in the livestock sector, and some moderation in the crops. Hog supplies, a lot of numbers here, and just a few of them I really wanted to point out. The big surprises from the recent hog and pigs report. If we look at the kept for breeding category, pre-report analysts had that anywhere from just above what last year was to about 2% above, average about 1% above, came in below about 1.1%. I was one guilty of this, thinking, we're looking at those forward margins for hog production. We're seeing return to at least what producers had for costs in the past. And we'll see ramp up production. I was looking at the sow slaughter data. I was looking at gilt slaughter data, which I'll get into a little bit more later. And just thought, well, we're going to see some expansion here in this hog and pigs report and moving forward. Came in below those levels. There is some of the thought that, we came out of quite a bit of equity drain. If we look at those returns that I showed in the previous few slides, we're building some of that back up before we're going to see the real surge in production. Impact of PED could be having some impact on the breeding herd. And so a few suggestions there. Not too surprised that we're seeing the market hog supplies and pipeline supplies below a year ago as we're starting to see the impact of PED rear. Where that's showing up a lot is that pig save per litter, where we've been seeing about a 1 to 2% increase per year, year over year. And we just seen just slightly above a year ago levels. Also interesting here is if you take, we have less sows than we did last year, kept for breeding category. But we actually expect to farrow more than we did the previous years in Dec, Feb, as well as March, May. I truly believe hog producers are going to maximize their farrowings given, what we're seeing for the profitability picture. But just from a number standpoint, a little interesting from the report that, fewer number of sows, increased farrowings the next two periods. Here's the Iowa case. A little bit more in line with that thinking there, where we're seeing about 5.8% decrease in the kept for breeding for Iowa, and we see farrowing intentions down year over year. They are intentions, but expectations are for them to be down. I always like to show these next two slides just to kind of tout Iowa and how much of a percentage of the industry that Iowa does represent. We're above 15% for as far as the breeding inventory. Also, we've seen very much the breeding inventory moderate and be relatively consistent comparing the last 20 years or so. We've seen market hog inventories explode. Iowa's over a third of the market hog inventory. How we've been able to do a lot of this is increase in efficiency, productivity, pig save per litter, litters per sow per year, we've seen those tremendous increases there. And also, though, given that productivity increase we've seen and the expectations that we would continue that, you throw in something like PED, that does have the impact of changing our projections, changing our forecasts of what hog supplies are going to be, how fast we can ramp up production, how fast we can put hogs on the market. So I mentioned sow slaughter. If we looked at throughout 2013, it was looking like we have to be showing expansion. We're seeing it down below 2012 levels, down below the 5-year average, especially July to December, typically a time where we see increased sow culling. We've seen that well below 2012 levels, well below the 5-year average levels. Gilt slaughter was down between about 1.5% to 3% on the year as we moved throughout the year. But we really seen hogs and pigs reports showed up, less kept for breeding category. So a little bit surprising there as far as looking at this market data. Pigs saved per litter, this just to really highlight kind of the trajectory that we were on, increasing between that 1% and 2% per year, and then throw in the September, November, just above a year ago levels. Really flattens out that trajectory that we've seen the last several quarters. Iowa, similar scenario there. Iowa actually showed up about 2.9% increase. I got my numbers right. Yep. But actually, we were down quite a bit the previous year. So, was there an impact of PED on, sow farms in Iowa? I think a difficult measure, just looking at the save per litter if you really didn't have the backstory of the data, as we were down significantly the year before and then popped back up to more trend line levels of pig save per litter. So I always like to give pig crop estimates, and I've had the opportunity to be on, the Hog and Pigs report with Steve Meyer and with some other economists, and always, we always like to give our pig crop forecasts, our slaughter forecasts, our price forecasts. And so when I wasn't on this last call, but I still like to do it just to know, what my estimates kind of match up with theirs, and then I have a benchmark for what we see the estimates next month. And these were increasingly difficult to do. How I do these is pretty simple. If you look at your farrowing intentions, your commensurate pigs per litter, to give you, a fairly good estimate of your pig crop. It's not going to be perfect, understandably, but at least give you some direction and give you a place to start. Well, farrowing intentions, I have a question there because, well, we have, decreased breeding herd year over year, but farrowing intentions are supposed to be up the next 2 periods. Pigs per litter, well, we were on about a 1% to 2% increase year over year, and now we're about 0 this last quarter, what we've seen. So where do I go there? So if you range that from about 1% to about, what we see in the previous period, we could see increased pigs per litter. I'm not that optimistic, seeing what the market is pricing in right now, seeing what the weaned pig market is. I'll get a little bit more into those supplies and prices. But, seeing we're having pretty tight supplies. I think an important note to make here, too, is USDA on their numbers, when they did their March, May, Feb of last year, overestimated those numbers, really underestimated the liquidation in the breeding herd that we did see. And so, while those might show between 1% and 2% increase year over year, those are actually, coming off a year that they had to adjust the numbers downward. So, weaned pig prices, 10 to 12 pound basis. Formula trade, this is pretty expected. It's based on a formula. How often those formulas get revised, how many moving parts are in those formulas. I mean, those are all, menu of options under there, but that trade's going to remain fairly consistent year over year with some seasonality, some volatility as far as those trade. But then we go into the cash market. We're really seeing start the impact of PED showing up. As we've seen really since June, July, we've seen that ramp up year over year as we're filling more of those orders for more of those losses of pigs. We're seeing this market become extremely tight here in the fourth quarter of the year, and also start fairly tight as we move into 2014. Similar story here, for feeder pigs, 40-pound basis, as we've seen those, ramp up since mid-year, become extremely tight and continue to be extremely tight as we move into 2014. And I'll go into a little more of this later, but this makes, we used to talk about, at least for weaned pigs, 50% of the 5-month out lean hog futures, pretty good estimate of weaned pigs. But now we've seen quite a bit of movement in that percentage. That's really altered, some decisions or at least some, math when we're talking about projected returns for the weaned pig, weaned to finish market. If we're talking about supplies, also need to talk a little bit about Canada. As we get, imports of live hogs from Canada, those are predominantly showing up as feeder pigs, at least from numbers, as the slaughter and cull market have really flatlined. But even the feeder pig market has been decreasing over time. We could get a little bit of support from that market as we're seeing our tight supplies and they're, offered those very competitive prices. But overall trajectory, that market's been down considerably over the last several years. Hog slaughter. Slaughter was down slightly 2013 compared to 2012, especially that September-December level. But there is a little bit of caveat there. Remember 2012, September-December, we had a big sell-off of hogs. We were increased marketings. We couldn't get the hogs out of the barns fast enough as we were paying, increasing prices of corn. We're seeing a little bit more delayed marketings come this last year as we've seen weights higher, as we're seeing relatively strong prices go into the fall and very cheap corn or cheap costs compared in relation to what they were paying the previous year. Also, USDA, I think, we should have expected though less slaughter given what the March, May, December, February pig crop actually was once we got the revised numbers. Those barrow and gilt weights, we're setting records every week it seems now. As we've seen now, those weights really take off, as corn became less and less. Finished the year, at very relatively high levels as we're really maximizing those returns. And then here started the year, well above previous year levels and averages. So overall, pork production was just slightly down given those higher and higher weights we were seeing of barrows and gilts, actually above the 5-year average. Year-to-date pork, we're ramping up there. A lot of that has to do with the higher and higher weights, again, that we're seeing. Pork in cold storage, here we're just slightly below 2012 levels in 2013, but, there's been a, move to have more and more pork in storage, allows for, a lot more marketing opportunities as well as export opportunities. So some longer term projections and that red box there I have highlighted to point out, that gets me into a little bit my pricing and demand story here. But overall, 2014, I think there's quite a bit of uncertainty about how much slaughter we'll actually see. The first 2 quarters, especially as we're dealing with the impacts of PD and how large that impact is, how widespread that impact is. But longer run, the industry is trending towards putting more and more product on the market as domestic demand has been, strong and warrants appreciation, as well as the export opportunities that we do have. Carcass weights, we've really been maximizing returns with increases in carcass weights, production increasing. But the red boxes I have highlighted there is per capita consumption. And really, per capita consumption is really just production, net of adjustments for cold storage, net of adjustments for import and exports, divided by resident population. And so, potentially there we could see decreases in per capita consumption of pork. Some of that could be price driven, as we're seeing higher and higher prices for pork. Also, you got to remember there was a lot of pork on the market as we were seeing it in 2013, and we could see a slight downturn in that here in 2014. Meat production. It wasn't too long ago that USDA was actually projecting we would produce more pork than beef in 2014. They've come off those estimates slightly now, as I think, impacts of PED potentially not the rapid expansion that we maybe had anticipated in the hog market, and so looking, levels of slightly below beef production in 2014, but 2015 potentially, could surpass beef production. Remember, beef production, just the biologics of the industry, how long it's going to take to build that herd, could be mid-2015 into 2016 before we're really seeing a net impact, net increase in beef production. And that's really, a lot of conditions have to go right to get there before we see that. There's a lot of incentives in the market for beef right now, but how fast we can get there is really just a lot of the science in the industry. If we look at broilers, we are seeing increasing egg sets, increased chicks placed, and so all indications there of increasing production for poultry. So if we forget for a moment impact of PED, the market signals are there for seeing higher and higher feeder pig wean prices. It's just like the cattle industry with feeder cattle. We see movements in corn prices will spur movements in feeder pig, wean pig prices. We see large increases will really drive down the value of those wean pigs because it costs so much more to produce those pigs. Flip side of the story, weakening in corn costs, we'll see increase in those prices. Very much what we've seen this last year. But it's very timely when that occurred. We hadn't seen the quite softening the corn prices, but really we've seen the increase in those feeder pig prices since we've started to first get the impacts of PED on the wean pigs, on the feeder pig markets, and those actual supplies. As far as prices, escalating since that mid-year, starting out above $50 for the formula trade, well above previous year levels for weaned pigs. You get into the cash market, we're above 80 as we start 2014, really where we left off for 2013. Feeder pigs, we were almost, I thought maybe potentially see the century mark, the kind of trajectory that we were on to finish 2013, but very much, above those levels, above $90 per head for feeder pigs. So this is where it makes it difficult. I provide a weekly crush margin. So this is just used in the futures market, assuming amount of corn going from wean to finish, amount of soybeans going from wean to finish, assuming a carcass weight. These assumptions are actually the same assumptions that are in livestock gross margin, and so it just made it easy to pick out some assumptions and not debate those too much. But also, I like to provide a pig price, and historically it's been pretty easy. 50% of the 5-month out lean hog futures. If you look over the data, it's really much fluctuated, plus or minus a few percentage points between that. But now, what do you think that percentage is now? Well, it's obviously above 50, right? So, we've seen levels as potentially as high as 70, 75. We've seen some weakening in the percentage sense as we've seen strength in hog prices. But you can see what that does to a margin standpoint, where we're looking at wean to finish, profitability above $40 per head there, just kind of an internal estimate. using some of our production budgets, we're looking potential, above break-even levels for the most part if we're back to that 50% of the 5-month out lean hog futures. You increase that percentage, as we move throughout the year into fourth quarter as we see some softening in those prices, potentially for red ink, from a margin standpoint. Barrel and gilt prices, I think we're definitely seeing an earlier run than we did last year. As suggested by the futures market of that April contract above 90, May contract, knocking on the door of the century, and then, above 100 for June, July contracts. So if you look at the volatilities in those lean hog contracts, definitely tails out there in those rather near-term contracts. As we're seeing, probabilities getting, significantly higher than they would be under maybe a more normal market or market that wasn't anticipating the impacts from PED, with, significant tails from those upward. And it's really not till October, December we're seeing more of a, return to bell curve, normal curve, and a little bit more certainty on maybe what those supplies are going to be. Also important to keep in mind, October, December, we always have more production, a lot more hogs moving in that quarter of the year. So prices will soften, at levels that we've seen. Pork demand, per capita consumption, pork's heading in the right direction, beef's heading in the wrong direction from a quantity standpoint. How much that does change, I think there is quite a bit of uncertainty when it comes to the demand scenario. As far as production, a little bit more certainty with beef. I think we know how long it will take to build the herd, how much those supplies are impacted. Hogs, I don't know if there's, as much certainty about, how fast we're going to build the industry, impact the PED, and really how much production is going to be available. Relative prices is always important. To a degree, they are substitutes in a consumer shopping basket, and there is differences in taste and preferences and such, but price does matter. We're starting to see a larger and larger wedge between beef prices and pork prices. We've seen, pork prices lately had increased. Now we're seeing, a little bit maybe leveling off or stabilizing at those levels. But, the question always posed here is there strategic opportunities for pork, from a relative pricing standpoint, given the direction that we really know what beef is going to be as far as, what pork prices will be. Pork prices, we love bacon. Iowa State University had their first Bacon Fest this year, which a wide hit. I think Americans' just real infatuation with bacon, which has really helped to, drive the hog cutout, really drive the retail prices on an overall standpoint or on a cutout standpoint. For hog prices, we've seen some actually strength in the ham market as of late as well. So this graphic just has price per pound. This is nominal prices, and then on the vertical axis there, or horizontal axis, vertical, pounds per capita, just to see our movement here, where we've actually increased per capita consumption here in 2013 with an increase in prices. This is on a nominal sense. Where we've seen the largest increase in price has really been the third and fourth quarter. From a year-over-year standpoint, and the first two quarters where we've seen the largest increase in consumption. So let's put this into a demand calculation, demand index. So I provide demand indexes, available to the industry here to show demand. And when I talk about demand, it's that per capita consumption, but it's also retail prices or deflated using CPI retail prices. It's what they're consuming and the prices that they're paying for those. And actually, the last 5 quarters, we've seen year-over-year increases in demand. We've got there 2 different ways with price as far as quantity. Here in 2013, over 6% increase in demand. Our per capita consumption is almost 47 pounds. Nominal price is at $3.64. The real price or deflated price of $1.56. So if we look at this from a demand standpoint, per capita consumption increased over 2% here in 2013. Prices increased over 3%. So if prices would have actually decreased, it had to decrease by over 2%, given the elasticity in the markets and willingness to pay, before we would actually see a 0% demand change. And so really to show you there, our big drivers of demand, we've been increased consumption and as well as increased prices. How far can those prices be pushed? That's a debate every industry has. The beef industry has been having it for some time, as we're seeing that escalation in beef prices being paid. So trade, and I can speak a lot more to this, I think, because I had the opportunity to go to South Korea and Japan with the Iowa Pork Producers Association as well as the Iowa Beef Industry Council. It was a true honor to travel with those 2 groups, as well as the state of Iowa. Really to see these markets firsthand, understand these markets firsthand, understand the challenges these markets have, as well as the opportunities that U.S. has there, as well as individual Iowa businesses or the producers that represent these organizations have there. Really eye-opener. Before this, exports were always just a big number to me, and the changes were the changes, and it was something you kind of just took for granted. But understanding those markets, how those markets need to be nurtured, and how important those markets, I think really was a eye-opener for me. 2013, we've seen exports down in pork. A lot of this has to do with higher prices of pork on the world market. We were talking to them, and they're fully aware of impact of PED. Their question is, how much is that going to impact price? How much is going to be available at what prices for us? These are the key markets for the U.S. In 2013 from January to November. We're still waiting on the December data. But Japan's been continuing to lead the way with just over a quarter. Mexico just under a quarter. Canada has been very consistent around that 11% level. China has weakened a bit. And then as well as some of these other markets, Russia, we've almost closed off trade with Russia. While that market was only about 5% in 2012, it was actually a growing market over the last several years. And so, removing 5% is a, considerable chunk of that pie that we had previous year levels. These are just the breakdowns country by country. We're seeing Japan, still deal with economic issues, the value of their yen, relative to the U.S. and, how much product they can purchase. China, while down 21%, China is one of those markets you really never know what they're going to do. You could see China up over 300% year over year, and then you could see them down 20% and very just in and out of the market. South Korea down 34%. Something I learned over in South Korea, they actually have too much domestic production. And so highly subsidized industry there, trying to decrease their domestic production. But until they do that, they've been consuming a lot of domestic product as far as their need for, the export market. And then Russia, they're down, about almost 94% year over year. So USDA makes kind of 10-year projections, and they'll be updating these in February. So these are 11 months out of date right now. But just, no specific numbers here to point to, but just, the general trends of the key markets, given, what population estimates are expected to be, wealth estimation, incomes, all of that are expected to be. The growth, obviously, in China, for major importers, but also, Central America, Caribbean, increasing not as much on a level standpoint, but percentage of pork imports, almost 60%. I think that Russia number will likely be revised considerably down, even on a 10-year time frame basis, given what we've seen this last year and a half or so. Short-term export currencies, and the relationship to the U.S. dollar are important as well. We look here where we see, weakening of the Japanese yen, stabilization of the peso, strengthening of the South Korean won, bodes well for exports as they have more purchasing power on their markets. The Chinese renminbi also increased, strengthening their relation to the U.S. dollar. We look at the major exporters, so these are the competitors to the U.S. Very much so. Competition bodes for cost of production. Who can offer, pork at the most competitive prices. But also, I think there's a point, the second point I make there, the world population is becoming increasingly educated, increasingly wealthy, and if they're going to increasingly pay higher prices for proteins because they have a lot of alternative choices, they're going to have to be, they're going to demand higher quality. That higher quality is really in the eye of the beholder, and that's going to change from one person sitting next to you to the next person. But to get that, these exporters are going to have to really meet that world demand, that world preferences. I think why the U.S. is such a leader in that is we've done a tremendous job in doing that, and we'll continue to need to do that. But Brazil, as far as a cost of production standpoint, very competitive with the U.S. and have that very much going for them. European Union, potential there for increases. And then Mexico as well, potential. But that's on a percentage standpoint. As far as levels, not as much increase. Export currency is the real mover here is the Brazilian real. While devaluing of the real doesn't bode as well for them, it does bode well for their exports, as their exports are, a lot cheaper on their global markets and make them, lower cost to, their major importers. I'm part of an international benchmarking group where we, enter hog production data and then submit it to this group, and it's all analyzed, and they spit out benchmarking data for us to look at costs of production across countries. So I always like to just show this slide that, U.S., even through, a pretty tough year as far as production, 2012, considerably lower than most other countries in this group, which are quite a few of the major players. Really, Brazil, Mato Grosso is really the only one that's competitive on a standpoint of cost of production. Kind of the warning here, these are estimates, really our best guess of what what we do, but I think they do bode well for looking at a trend standpoint, which we've seen increased production the last several years, and a relative standpoint across major production regions. So what's this all mean? This is kind of Lee's sermon right here of finalizing points. I think next 12 to 18 months, profit opportunities, right now the market really is showing profit potential out there. Domestic demand can hold. I think there's no reason to expect that it won't, given the stabilization and actually increase in demand we've seen the last several quarters, last several years. Export demand can hold. I think, given our cost of production, our product is so desired on the world market, no expectations that will soften much, if any. And then as far as cost of production, I think the modest rebound in crop demand, we're seeing very competitive corn, soybean prices for alternative uses. We could see some spur in some of that demand if it be exports, if it be some of those other markets. and kind of continuation of moderation in those input prices. Who will share those profits? I think that's a little bit less uncertain. We're dealing with the operational impact of PED, which could be, quite devastating. Where we're seeing some of the reported mortality losses and that, very terrible from that standpoint. But there's also a market level impact of PED. And what's that doing is offering, very much risk premium on prices. If we look at really across weaned pig prices, across finished hog prices, very strong prices throughout this next year, and a lot of opportunities for producers, to kind of hedge some of those prices or lock in some of those prices and chase some of those opportunities. And then here, the strategic opportunities for pork, if it comes from a relative pricing standpoint, if it coming into some of our key emerging markets for pork exports, as we'll be offering more product, eventually here at lower costs of production and offering very competitive prices on the world market. Longer run, I think there's no real question if the industry will gain more production capacity given the demand situation that we have. I think it's really just how fast. We maybe softened off those expectations a little bit, given at least I expected a lot more rapid increase in expansion. But I think, the general trend is increasing production driven by domestic and global demand, which I mentioned there. Really, nothing to suggest weakening of demand domestically or globally. Export market, we're reminded of this time and time again with the trade issues, be it ractopamine, be it, et cetera, that, the export market can be very fragile. We can lose those markets rather quickly, and we know how long it takes to build those markets back up. The case with BSE and cattle, we're still, building up to the levels we've seen in Japan from when those markets were closed and those restrictions reopened. And I think those markets really vary. Some are very price sensitive. While price ranks very high, some other ones, other quality factors or other phytosanitary factors rank, within that menu of options for them or their preference ranking. Understanding those, will be ever important as we move forward. We're coming off, the base fundamentals anymore. This job, I think may have been easier back in the day because it was really just, you kind of knew what supply was, you kind of knew what demand was, but now we have a lot of those other factors. Being, animal welfare issues, sustainability. It's all those other factors that really drive demand, drive production, one way or the other. And I think really to embrace those, understand those views, not necessarily market those views, but do the best job to, understand those and do your best way to proceed will be increasingly important, to kind of hurdle some of those obstacles that may show up.